careful what you wish for. Hedge fund manager warns Biden's spending plan could pop stock market bubble. Biden announced the details of the $1.9 trillion bailout package on Thursday. The American Rescue Plan is designed to support households and businesses through the coronavirus pandemic. David Neuhauser, managing director of Livermore Partners, said that Biden's spending plan looks like an attempt to mimic the Roaring Twenties by quickly returning people to the workforce. Separately, Jim Sullivan, head of Asia's former Japan stock research at JP Morgan, told CNBC that Biden's plan was a positive surprise for the market. According to a hedge fund manager, Joe Biden's COVID spending plan, elected by the president, could recreate the financial conditions seen before the 1929 Wall Street crash, where increased inflation was potentially responsible for bursting an epic stock market bubble. The comments came shortly after Biden summarized the details of a $1.9 trillion rescue package designed to support households and businesses through the coronavirus outbreak. David Neuhauser, managing director of the small Chicago-based hedge fund Livermore Partners, said Biden's spending plan looks like an attempt to mimic the Roaring Twenties by allowing people to quickly return to the workforce. But watch out, the Roaring Twenties led to the crash of the 1929 stock market and the Great Depression. So be careful what you wish for, he added. If it passes through the new Democratic-controlled Congress, the American Rescue Plan includes $1 trillion in direct aid for households, $415 billion for fighting the virus, and roughly $440 billion for small businesses. We don't just have an economic obligation to act right now. I believe we have a moral obligation, Biden said on Thursday, announcing his plan from the transitional headquarters in Delaware. The former vice president will take office on 20 January. When investors were asked whether they should be worried that the incoming president's spending plan could lead to an event like the 1929 stock exchange crash, Neuhauser replied, "I think so. You are seeing this huge $1 trillion deficit spending in the past 9 months due to an epidemic that has of course stopped the world. And of course the goals are we will and get a vaccine," Neuhauser told CNBC's Squawk Box Europe. "We still do not know the dynamics of how quickly we overcome this. We do not know what global growth will be like in the coming years." After the stock market crash on October 29, 1929, the S&P 500 fell 86% in less than 3 years and did not surpass its previous peak until 1954. Neuhauser voiced expectations that the US GDP, which is gross domestic product, could grow 6% in 2021, but warned that growth will normalize by between 2% and 3% in following years. An aging US population and enormous corporate and government debt also mean it will likely be a hard road ahead. Neuhauser's view is not consensus, though. James Sullivan, head of Asia's former Japan stock research at JP Morgan, told CNBC on Friday that Biden's plan is more than double the amount the bank expected. Therefore, it has been a positive surprise both for the market and for the overall levels of US economic growth in the coming years. Separately, Goldman Sachs analysts raised their financial spending forecasts in the news in a note Friday. They noted that Biden's proposal went further than they expected in terms of individual incentive payments, unemployment benefits, state financial aid, and public health financing, but they stressed that it faced obstacles while passing through Congress. Inflation alert. Contracts based on the Dow Jones Industrial Average dropped 89 points, while US stock futures fell on Friday morning, while S&P and Nasdaq were trading in the negative territory. Major US indices are currently on their way to closing lower from week to day. However, Dow and Nasdaq recorded an all-time intraday high in the previous session, while the S&P closed at around 0.81% off the record level. The market is trying to understand what expression they should go with, and for the past 9 months, it has been on the rise in terms of stock markets in an almost straight line, said Neuhauser. I think what's happening in the end is that there's so much will be built into the market, and we will eventually begin to see inflation factors hold on. Ultimately, these are the things that pop the epic bubble. Earlier this week, data showed that US consumer prices rose in December due to the rise in the price of gasoline, but inflation remained relatively flat. The US Department of Labor said on Wednesday that the consumer price index rose 0.4% last month, after rising 0.2% in November. In the 12 months through the December, CPI increased 1.4% after a 1.2% increase in November. The numbers were largely in line with the economists' expectations. Will inflation cause my investments to decline? As inflation increases, the purchasing power of cash decreases. Therefore, keeping the money in cash at low zero interest rates causes the currency to depreciate in an inflationary environment. Higher inflation may be pleasant news for borrowers, as it reduces the true value of the debt. While investing in stocks carries risks, it can be a great way to beat inflation. If my investments can generate a higher return than the rate of growth and inflation, then I will pay too. The point at which inflation can negatively affect financial markets is when it rises above 2%. This will increase the pressure on central banks to increase interest rates. Higher interest rates increase the cost of debt. Most obviously, higher mortgage payments. It also discourages spending, which is bad for an economy trying to revive itself. These high interest rates may cause my investments to lose value. In a period of high inflation, it makes sense to buy stocks in industries that could weather the storm. Therefore, I will consider gold or oil stocks and consumer goods companies such as Unilever or Tesco that will always be in demand. Credit Crisis 2.0. The current economic situation is reminiscent of the 2008 credit crisis, but not the same. While responsible lending causes this situation, we cannot blame the coronavirus crisis for financial missteps. The fight against economic debt poses a mystery because raising interest rates creates a nightmare for individuals and businesses who are increasing their debt to escape the epidemic. As a long-term shareholder, I am not too concerned about short-term inflation fluctuations. However, it's important to keep a close eye on investments and avoid holding companies with excessive debt. Register with Motley Fool today for regular Motley Fool stock market investment ideas and help with selecting the best UK stocks to buy now. A stock for a world after COVID. COVID-19 divides the investment world into two. Some companies have seen an explosion in cash flows, an increase in valuations and record results. Others are stingy and suffering. All industries seem to disappear. Such world-changing events can only happen once in a lifetime. It seems there is no middle ground. Financially, you will want to learn how to position yourself on the winning side. Therefore, our expert analysts prepared this special report. If the pandemic has completely changed our lives, we believe that this stake hidden inside the tech-heavy Nasdaq could be adjusted for terrible gains. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.